Back, let's get into that market picture now. Asian and even European markets thus far have rallied today, and that's following a strong lead from Wall Street last week and comments from Donald Trump's top economic advisor hailing what has been positive trade talks with Chinese negotiators over the phone. Optimism that central banks will provide fresh support to head off the global economic recession has also given a much needed boost to regional equities after last week's massive sell-off. Now, with eyes on an upcoming speech by Federal Reserve Chair Jerome Powell for clues about its plans on interest rates, a lot more of the market will indeed be shifting its focus. Now, investors were in an upbeat mood as Tokyo's Nikkei added 0.7%, managing to close then at 20,563 points. Big gains then for the Hang Seng, 2.2% higher there, sitting at 26,291, while the Shanghai Composite was 2.1% higher as well, gaining by close of trade. Over in the United States last Friday, Wall Street managed to close what has been a roller coaster week on a positive note amid hope for progress in those US-China trade war scenario and negotiations and a reprieve from recessionary fears, with all three major indices posting solid gains. US economic data was mixed, but offered good enough news not to ruin the party created by President Donald Trump's announcement that he has had a phone call scheduled soon with Chinese leader Xi Jinping. Now, after a wild week in which the Dow Jones Industrial Average posted its worst day of the year, the index ended the session with a gain of 1.2%, but still down compared to the previous Friday. Now, the broad-based S&P 500 managed to jump 1.4%, and that managed as well with the tech-rich NASDAQ Composite Index increasing 1.7% by close of trade. Let's head on over now to the European countries and how those have fared. A lot of interest coming through not so long ago as well then. Germany saying that perhaps that market could have continued to fall in the next quarter as well, in the third quarter, as production there continues to simplify and perhaps weaken ever so slightly. So perhaps a few more worries then for that European Union and that European zone. But for now, onto the market picture, it hasn't necessarily impacted it quite as much. So for now, we are seeing that rally from across the globe continue to filter through and even head on to the local market, where if you take a look at that then on the JSE, that's also gone into some positive territory. The likes of Tencent, of course, have gained massively earlier this morning following the results out last week, and that continues to affect Naspers on the local bourse, and that has headed higher today, and so too have the industrials. On the resource share front then, it hasn't necessarily been the greatest day for the gold counters, which of course last week were the safe haven as investors begin to just pull out ever so slightly and head off into other equity counters. They have made sure that the rest of the resource shares have, however, looked a little bit better. On the overall front day for the commodities, those have been a mixed bag thus far, with the gold price now just sitting below that 1500 mark there, 841 then for platinum, then for sitting down ever so slightly from that 850 it reached even last week, while the oil price is below $60 a barrel and headed higher, as perhaps the hit then on that Saudi oil ministry is perhaps a bit of a concern, and demand then in the market perhaps not as high. Taking a look at the local currency, continued weakness sitting at that 1533 rand mark against the US dollar. That will really be synonymous and very key as we get into inflation data, which comes out for South Africa on Wednesday, because if that heads below the midpoint of the target band of between 3 and 6% for the South African Reserve Bank, but you have a consistent pressure level on the currency, it may not necessarily give the South African Reserve Bank enough impetus to cut interest rates again, whereas inflation is of course on a low front. So we'll certainly see how things fare with regards to that. Perhaps dipping below 15 rand won't be such a bad news story. The euro above that 17 rand mark. Let's chat to Gary Boyson now, who joins us of course live from the Johannesburg Stock Exchange as we unpack this market data a little bit. Gary, thank you so much for the time. So of course some keen interest. Yes, we're rallying as well, following through with that global market picture, but not really much to write home about. We're not doing this on our own.
Yeah, it's very much internationally driven rally that we're seeing. I think it's a big week for central banks. We've got FOMC on Wednesday, so we'll hear a little bit from the Fed. But we've also got central bankers meeting in Jackson Hole, Wyoming, and we're expecting Jay Powell to speak on Friday and really just try and reassure markets that potentially things, that they are standing ready to act should the economic situation worsen. We're also coming off the back of the potential stimulus out of China. China, where the PBOC was adjusting just the way that their lending rates operate to try and guide rates lower for Chinese corporates. That also at least assisting equity prices. And the general rally, South Africa really being swept up. If you look at the local front, not too much local news. The Sense feed is pretty quiet today.
I just want to talk about Germany and perhaps the European Union, and perhaps as we continue to talk about that global recession, right? We have the impact on how that and what that means rather for perhaps the biggest economy out in that Eurozone. You're seeing thoughts there where the German economy could have continued to shrink over the summer as industrial production drops amid a dearth of orders. That surely just points the picture. We saw a contraction in the second quarter. We're going to see another one then expectedly in the third.
Yeah, it's interesting how financial markets trade. So while we're seeing more and more negative economic data coming out across the globe, Germany included, we're seeing more and more hope that we're going to get some sort of intervention from either governments or central banks. So Germany now is apparently rumored to be looking at a fiscal policy, a fiscal stimulus package to the tune of about 50 billion euros that could potentially help to lift markets. It's one of the reasons that you're seeing the DAX up today. So while we are getting weaker economic projections, you've always got to remember that financial markets are forward-looking, and they're now looking at these weaker, potentially weaker economic numbers and saying, what are authorities going to do about it, and will this bode well for future growth? So interesting, we're getting kind of that converse market reaction where we're seeing weaker expectations for economic growth, yet we're actually seeing equity markets rally on the hopes that potentially there are packages that are going to be put in place that will assist.
Yeah, I find it funny that the scenario is playing out, yes, of course, in the established markets, but also too in emerging markets and perhaps the lower end of the scale, if you were to think about it. The finance minister of Zimbabwe has suggested that he'd like to boost wages in both the public and private sector as well in order to restore living standards and create consumer demand. That's exactly what's kind of happening out in China as well. And yes, Zimbabwe is a different case in itself, but it does tell you the sentiment of the market across the board. Are we looking at stimulus plans for almost as many nations as possible now?
No, certainly we're entering a strange era in financial markets where we've had, an economic expansion, certainly in the US for a very, very long period of time. But it's been a very subdued expansion. So now that we're starting to get concerns around global rates, at least global growth, you are seeing central bankers and you're seeing, policy authorities trying to assist markets to move firmer. The problem really is, though, that, essentially we've got negative yields across, it's around $16 trillion worth of international debt. And they really are facing the zero bound problem where you're in a position where you haven't quite had growth robust enough to bring through solid inflation. So you don't really have interest rates to cut. And you're facing this strange situation where you have to attack the problem from very alternative points. One of them is the old QE packages that we had out of the US and some of the other developed markets. And just trying to work out ways to stimulate the economy when you essentially don't have interest rates to cut.
Yeah, and Japan then, of course, we're seeing exports there suffering, the trade war playing its part as well there. How much worry is there that the third largest economy in the world will enter a recession as well?
So certainly Japan is always linked to the demographics of Japan as well. It's an aging population, and without population growth, you're not going to get that absolute boost in economic activity. So if you look at the import-export numbers this morning, they've been declining. Part of this is, as you say, because of the subdued patterns of global trade. People are not trading as much, and it's one of the reasons for the increased fear over global growth. But if you actually look at the numbers that came out early this morning, we saw that both imports and exports have declined again. As I said, this is a trend that's been persistent for most of 2019, but they did come in slightly ahead of expectations. So Japanese imports and exports not shrinking by quite as much as we expected. So it's really an expectations game, yeah. And I think that also assisting to help Asian markets move a little bit firmer, just because it's not quite as bad as we expected. We were expecting it to be bad. It wasn't quite as bad as expected.
Yeah. Locally, though, we have inflation coming out on Wednesday. The rand not necessarily doing us any favors, but expectation of at least hitting that midpoint, if not lower, than the inflation target.
So certainly, I mean, if you look at South African inflation, we have been around the midpoint of the band for a fair amount of time, and there's a lot of arguments to be made that our central bank should be cutting interest rates. If you look at the Reserve Bank's models, we could potentially have a rate cut. I think the concern is absolutely around the volatility in the currency. It's around the fear that we may potentially be downgraded, and they're looking, whenever the South African Reserve Bank is looking to cut interest rates, they're looking at inflation in probably 18 months out. They're trying to look into the future, whereas obviously the numbers we get are historic. So if you do look at it, if you compare our real interest rate, which is obviously the nominal inflation rate minus inflation, and we do have one of the highest interest rates in the world currently. So if you look at it, there should be scope to cut interest rates, but certainly that inflation number will help to be an input into the Reserve Bank's thinking, and it should improve the estimates.
Anything you're looking forward to on the equity front for the remainder of this week? Gary, I don't know if you caught that. Just wanted to ask anything you're looking forward to for the remainder of this week on the equity front.
Seems like we're having some sound issues here.
All right, we'll just leave it there then, unfortunately. Sorry about that, Gary. Unfortunately, we'll leave it there then. That's Gary Boyson from Rand Swiss joining us live from the Johannesburg Stock Exchange, helping us unpack that market picture. Very quickly before we head off, then the Bank of England's governor, that's Mark Carney, saying that the chances of a negative interest rate out in the UK is very unlikely. It is not an option that they're currently looking at. Let's remember that a lot of the advanced economies, particularly in Europe and also out in Southeast Asia, have negative interest rates, which they've tried to create more demand in their economies, perhaps raising inflation somewhat. So he says, however, that does not seem to be an option for them, and they will look at other methods as the rest of the world heads into stimulus.